You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributor to Backroom Technician. This week on The Biz, our Truth and Taxation series, and on today's show, a tax deferral impact with national columnist, certified financial planner, and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone, and I love to say Ken's line, tax deferral is now king. I mean, when you think of all the all-in taxation issues, we've been talking truth taxation because there's so much stealth and hidden taxes, deferring it as long as you can, and especially tomorrow we're going to talk a little bit about advisors deferring their comp. You know, that's a whole other issue. You want to start looking at tax deferral as a legit. I remember back in the day, I mean, deferred compensation was the game because tax rates were so high. So people said, hey, I'm just going to put this off, and hopefully by retirement my rates will be lower. Wow, what a myth. Okay, let's talk about it. First, let's do, how do I make deferral affect my AGI? How do I do that?
Well, you know, part of that is obvious. I mean, if you have money in an IRA, a life insurance policy, an annuity, and you're earning income on it, and you get no 1099, well, obviously, that doesn't flow into gross income, which flows down to AGI and then to taxable income. And what we're going to be focusing on is controlling AGI, because we need to change the focus from purely tax rates and taxable income to AGI because it affects so many other features of the code. The other part I think is a little more surprising is when you use a combination annuity, use maybe a 5-year immediate annuity in combination with a deferred annuity. Well, we don't think about an immediate annuity being a deferral because it's an income. But the fact is that we get to take our tax basis for non-qualified annuities assets and we get to amortize that over 5 years on a straight line basis. That really is a tax loophole because conventional accrual accounting would say you'd have you know, more interest in the earlier years and less principal return. So, you know, if I get $10,000 invested over 5 years, I divide 5 into 10, get $2,000 a year deduction. So if I make $2,300 a year, only $300 in excess of the 2 is taxable. So I've got a portion that's giving me amortized straight line basis and the rest is deferred and deferred annuities.
I think sometimes we forget about this and the AGI impact, which is so crucial to our thinking. Because we're sitting there going, wow, after TEFRA back in the day, in I think it was 82 or whatever it was, 81, somewhere in that vicinity, in August, they changed the rules. It went from first in, first out, right, to last in, last out. So you're getting taxed.
Last in, first out, yes.
So you're getting taxed now on the gain up front. But when you amortize, or actually in this case, annuitize, and you're using an SPIA, you know, immediate annuity especially, you're getting some of this spread. And I think that's a huge issue when you think about getting some of your basis up front day one.
Well, and we have those reports free to our listeners from Backroom Technician that basically explain amortization of basis, annuitization versus withdrawals. And it's only, what, 3-4 pages? It's not hard to consume. It's written in simple language so that we can all understand it. It's accurate. And then once you know, just read through it and then start handing out to your clients. So you have information on immediate annuities, deferred annuities, how all that taxation works. It's really not that hard to grab onto. Once you know, our advisors really understand that, they can start using these techniques and explaining it to the client that, gee, I can take your CD, money market, municipal bond fund, taxable bond fund, switch it over to a layered annuity, combination annuity, split annuity strategy where we can greatly reduce your gross income, thereby reducing adjusted gross income, and then make your deductions, credits, exemptions more effective, reduce taxation of Social Security, reduce Medicare premiums, reduce potential AMT, possibly affect the Obamacare tax. There's a lot of things that if we can control that AGI by using and just shifting from one balance sheet item to another, from one low-risk interest-bearing asset to another low-risk interest-bearing asset, all we're doing is changing the tax game by going from one kind to another and employing these special rules.
When I think about it, and again, you know, you're just quoting off Backroom Technician, you can hop out to that site and get a free 30-day trial. Pull down the report he's talking about. I think it's great. Just go out to our site, thebiz.tv, and as soon as you come out there and you see the little BRT icon, just go ahead and click on it, sign up, and get your 30-day free look at this. To me, you're going to be looking at documents that you're going to be using. I've been using it for 23 years. Ken, you've been using it for a lot, for maybe a half that time. When we think about it, Most of the stuff, if you go out to see my actual training videos on annuities and life insurance, 85 to 90% of the docs I use are coming right off background technician, and I've been filing CPE, CLE with the fiduciary community for the same thing. Sorry for the commercial. Had to just bring that up.
And the thing is, if people want to go out and do talks, educate the public, get the word out that that deferral is king, show them how these types of things work, they can build their own little reports with tables of contents and everything else. You taught me how to do that years ago. And gosh, I want to talk on a thing. Oh, up comes BRT. I do my little report. I go out and I hand it out to everybody. It looks like a really professionally done piece that I wrote, and I didn't. I don't tell them I did, but they assume that I did, and they get something to walk away with. It's a great way of quickly jumping into this thing and getting some of these concepts across to larger groups, to individual clients. It's good information, and this is how we manage this stuff.
When you do the 30, and again, I'm not trying to make a commercial out of this, but this is information. You need to use this, and we give a significant discount for our viewers. If you go to our site and you sign up, you look at this, you take your 30-day free trial, you take your for a drive, and you say, man, I love this. And you're going to be coming through Brokers Alliance, our other sponsor. You're going to be able to tag into that and be able to say, okay, that's great. I'm going to get a discount. And I think, I could be wrong on this. I think it's like $50 a month. Why would you not do that? Forget about, and remember, a lot of the BDs already made this compliant. Now, when we're talking about some of the things we're saying here, we're talking about life insurance, and remember, so many people, we think we all know this, we do in our business, but consumers have yet to figure out that some of the great cash value life insurance contracts, which I like indexing, and sometimes I like whole life, depending upon what the situation is, I can pull out withdrawals to basis and tax-free loans, as long as I keep the policy in force. That could be huge for a client if he's willing to hold on to it forever. When we come back from the break, we're going to continue to address the significance of tax deferral impact, part of our Truth in Taxation series with Ken Davis. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Hello everyone, I'm Steve Savant, host of the daily internet talk show, The Business Insurance Zone. I've been using Background Technician for over 20 years for my edutainment workshops, public seminars, and my ultimate resource for my consumer shows. Why? Because it's the best needs analysis and sales support material that addresses almost every financial planning scenario. And now you can test drive Background Technician absolutely free for the next 30 days. Go to thebiz.tv and click on the BizBlog menu and sign up for the most powerful resource available to financial advisors. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's material at thebiz.tv. And while you're out there, don't forget to click on the Background Technician icon for a free 30-day free trial offer for access to the best needs analysis and client educational materials that address almost every financial planning scenario. And of course, we just talked about that. Felt like it was a big commercial for BRT, but we've been using it in our practice. It's so much part of our life now. It's just, I don't mean to be a living commercial here, but pretty much that's what it is. And remember, before moving forward with any of the ideas on the show, always consult your tax advisor, especially this week, and your broker-dealer compliance department before you use anything that we have, and we have a ton of materials for this week. So we continue to address the significance of tax deferral impact, especially on AGI, part of our Truth in Taxation series with Ken. Ken, let's get down. I want to talk about, and I love his phrase because I've seen you write about this before, the impact of combining real cash flow with tax savings against alternatives. Why is that such a powerful tool?
Well, it's interesting. When I talk to certified financial planners who tend to focus mostly stocks, bonds, that type of thing, and life insurance and annuities frequently is a very much a secondary consideration. Well, there's two things. One, the fixed income portion of a portfolio, if you're in long bonds, if inflation takes off, right, and interest rates go up, the value of bonds is going to decline, okay? So that's an issue. So what are the alternatives? Well, if you look at these combination annuities, part immediate annuity, like a 5-year immediate annuity, and the rest deferred, what's happening is that not only are you making that cash flow, and I'm saying cash flow as opposed to interest, because we're taking cash flow and letting interest grow, okay? We're replacing interest income with cash flow off the immediate annuity. What happens then is not only do we get that cash flow, but we also get the tax savings. Now, we now have something that other interest-bearing assets, including municipal bonds that are included, the interest is included in the taxation of Social Security. We now have something that when you combine the actual cash flow and interest income with the tax savings and then compare it to the alternatives, it's a much more powerful tool.
And when you think about it, at first, it does not sound intuitively correct. I'm just taking principal from my annuity, I'm giving myself cash over 5 years, 10 years, whatever it is. And then I'm deferring the rest. But when you look at it all in on taxes, and this is why we keep coming back to this AGI, we just keep running it into the ground. AGI, and especially Social Security during retirement, this makes an impact. And so you're able to delay or defer can have huge impact on your ultimate cash flow throughout the life of your retirement.
Well, that's right. And of course, those of us that study financial strategies know that time value of money is important. If we can defer to the future, we add value. However, consider not just doing layered annuities, but on the last piece of this layering, throw a life insurance policy in. We tend to shy away from buying life insurance for 65-year-old people. Why? Because it takes a good 15 years for life insurance to accumulate properly, get past the penalty periods, that kind of thing, and it's frequently not appropriate. But if you have 15 years worth of annuity income, and then the last piece is life insurance, and you start in that last tier,
you can hold it that long.
Drawing money. So a 65-year-old is now 80 years old. Well, if they die prematurely, then there's a windfall from the life insurance.
Self-funding.
No income taxes, no estate taxes if it's done properly, right? Now, where we've got tax deferral on annuities that eventually we have to pay the piper on, now this last piece, we deferred income, and now we're getting tax-free income in the form of either tax-free withdrawals or loans against the gains, and tax-free death benefit in the very end. So we actually improve this concept of combo annuities or split annuities by throwing a life insurance element in, and we're using it appropriately because we're giving it time to mature and to do, its best work.
Well, when I think about the combination of that, I mean, to me, we have to look at it all in. And especially the longer you can hold on it. And remember, you say, Steve, I'm 65, it's really inappropriate. I think it is, usually, if you're not doing this. But remember, you could be looking at surrogate insurance, somebody in your family, maybe that are younger. You can use them as a substitute insured. It could work out. Ken, I want to shift gears a little bit. You're talking about keeping money in fixed annuities that adjust interest rates each year and this 5% penalty issue. Talk about that, because I don't know if people understand that.
Well, I've been giving it a lot of thought, and we have to look at where there's objections to what it is we're offering. We have to look at what the regulators and the commentators are saying about our practices, our sales practices. And one of the big issues against annuities is 10, 12-year penalty periods and the high penalties that are associated with these annuities. Well, if you do these layered annuity strategies, a 5-year immediate, 2 5-year deferreds, and then an indexed annuity with a living benefit rider or a life insurance policy, those first 3 segments are all 5-year maturities. They're 5-year penalties, and then they come due. The other thing is you can do a MIGA, a multi-year guaranteed annuity locked in for 5 years, or you can say, gee, as low as interest rates are, 1.5% seems like nothing. Well, it's 3 times what CDs are paying, and it's tax deferred. And we know that each year the life insurance companies set new interest rates. Well, with a short year penalty period, they're not going to abuse you because you're going to take the money elsewhere, okay? They have to, the market keeps the flame to their feet, to be honest with us. So yeah, maybe you take low interest rates, but as inflation takes off, as interest rates take off, I believe, this is my best guess, and I don't know this, of course, it's not guaranteed, but I suspect we're going to see interest rates rising in the next 5 years. And so maybe we bite the bullet, get low interest-bearing assets now with the idea that we're not going to get beat up by inflation and interest rates on our long bonds or other assets that are adversely impacted. Let it grow with the markets.
Yeah, just think about that. Ken just brought up that long bond. You're exposing yourself. It could be devastating during inflationary times. I mean, it could be an issue. Again, I don't want to get into that from a security point of view, but it could be big. Remember, you can watch our show and all the shows we did this week. Go out to our website, thebiz.tv. And remember, you can follow me on Twitter, Facebook, LinkedIn, Pinterest, and Google+. Well, that's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.